Data Patterns reported numbers, and I'll just quickly summarize the full year numbers. So revenues are up 15%, EBITDA is up some 30%, and profits went up about 47%. These are full year FY24 numbers. We have the management now with us for Data Patterns to talk about what FY25 may look like. Mr. Srinivasa Gopalan Rangarajan, Chairman and Managing Director at Data Patterns, is now joining in. Good morning, sir. Great to have you with us here. Thanks very much for your time. Prashant this side. Can we start by asking you what happened in 24? Because the guidance was for a 25% top line growth. You've done 15%. What can we expect for FY25 on top line and on margins as well, sir? I think you'll have to unmute yourself. Go on, sir.
Am I audible now?
Yes, clearly.
Okay. Good morning. Thank you for having me here. Yes, answering your question, last year, the guidance was around 20%. We could not ship a couple of projects, which is ready for shipment, but we couldn't ship it due to, inspection delays. But the product will be shipped probably this quarter. This year, guidance about 20-25% in top line growth, and retain about 30% bottom line growth, which is what we've achieved in the last so many years.
Has it already got this shipment that you're talking about? Was it just an operational delay? Was there any? Could you just go into the details a little bit?
No, we have a couple of shipments which are ready for shipment, but inspections got delayed. The inspection is about to start now. So hopefully the inspection starts this quarter, we will be shipping it. But the products were ready last year for shipment, and this is part of original plan. So there was a small dip in revenue, but that has been compensated because last year to this year, our margin percentages are much better than last year. See, this has been contract to contract. So you see that last year to this year, our EBITDA margins have gone up from 37%, 38% to 42%. So we had a slightly more profitable kind of contracts negotiated this year. So we're okay on the bottom line as per the predictions.
Mr. Rangarajan, can you help us with over the next couple of years, what is the proportion of orders that you're expecting from defense versus from space? Where do you see the largest amount of opportunity now? And will the dependence of DRDO reduce over the next couple of years?
Okay, see, largely the growth is going to be in defense, not so much from space. The space is actually a smaller player compared to defense in this overall gamut of market space here. So the larger play will come with defense. We expect this year about 1,000 crores plus on terms of new orders. This is all based on single tender contracts, which we've already earlier quoted. A repeat order is coming, or some other contracts which you're going to get this year. We're not including the tendered market. We don't know which way it will go. We're talking about some more estimates. Only thing, there may be some delays up and down in the kind of contracts which we're going to get. But the estimate is about 1,000 crores plus we should get this year. Regarding the other point,
I just had a follow-up. You said 4,000 crores of new orders from defense is what you are hoping to receive, or you've already got?
I didn't say 4,000, I said 1,000 crores plus.
Oh, 1,000 crores. Okay, sorry, I heard 4,000 crores. I was wondering. Okay, 1,000 crores of new orders from defense is what you're looking to get, right?
Yeah, and gradually the market size will grow in the MOD business. And as you grow up the hierarchy in terms of full systems, the DRDO business will slowly come down as a percentage. If we continue to grow at the percentage we are growing now, DRDO is a significant portion of our company. We expect it to continue for more time to come. But the growth will happen over the next few years, next 5 years. It will come from direct MOD business.
Okay, all right. Hi, good morning, Mr. Rangarajan. So, 1,000 crores of order inflows is what you're looking at as you're de-risking yourself from DRDO business. Got that. Just to reconfirm the numbers for the current year, revenue growth of 20 to 25%, margins of 40%, and PAT margins of around 30%. Did we get those numbers correct?
That is what we're expecting to do this year.
Got it. Super. What about the exports business? That was relatively smaller, but you were talking about it going to double digit, I think so. So in the past year, how much did exports contribute, and where is that number headed? And I think the cash conversion for you is around 300 days, right? It holds around those levels?
Yeah, the export business is about 6% last year, I think. We have contracts of about 60 odd crores, maybe about 80 odd crores. Again, contracts on hand for export. We expect to complete those exports this year. And some more export orders are expected as we go along. But this is not going to be a significant growth model today. The growth is going to be in building full systems for MOD. And once the systems are built, we plan to export those outside India. So that is how the growth is going to happen. Though we are in discussion many foreign multinationals, but that is to come to a large size business is going to take a few more years. Yes, we are trying to increase that business over the next 3 to 5 years, but that is not going to be an immediate revenue potential. So this is where it is. The second question I forgot. What did you ask?
No, the cash conversion days, sir.
Yeah, we expect the cash conversion days to come down from 300 odd days. It's come down as you go along. More and more production business which you do, the cash conversion cycles will come down. Today, we are largely dependent on development orders. That is why the conversion cycles are slightly longer. But as you go along in the next 2 to 3 years' time, the working capital days, the net working capital days will come down. Though we are stocking a lot more than earlier because of large order book we have, and we've stocked material for this year as well as next year deliveries. So the inventory levels have gone up somewhat, but this will be brought down as we go along.
Okay, 2 quick questions. One on the radar business. How is it doing right now? Radar and electronic warfare both. What kind of potential do you see there? And also, are you looking to invest more in the satellites business? What is the addressable market like over there?
The two key areas for data patterns is radar and electronic warfare. We almost do everything in electronic warfare with DRDO. Now we have spent more than 15, 16 years in development of full systems in EW. Similarly, in radar, now we are building our own radars. We satisfactorily executed the 9 radars orders we got from Air Force and Navy on the open tender. We received this in 2020. We have delivered the full radar set. 9 radars have been delivered to Air Force and Navy. Similar to that, we are now participating in other Make-2 programs, as well as ab initio development we have started because we raised money in the market last year to do product development. We have started development for fire control radars, EW systems and suites, communication equipment. All this product development is initiated. The moment the products are come to, starts getting into trials, we expect some contracts to kick in. This is all, we are spending a lot of development money now to build future business. We expect the next 2 to 3 years, we'll start getting the large businesses as we want to go because the market size is very, very large. And unless we have products, we cannot increase our total addressable market. So instead of going and collaborating with the foreign companies, we're thinking of building it on our own. So with the result, we've raised the money from market. We're spending the money now building products. I think you'll see the change in the next 3 to 5 years. The large order book will change based on that.
So when you say you're spending a lot of development money, what exactly is the capex over the next couple of years that you've outlined? And will it all be pulled in from the market? Will there be any debt that you would be looking to raise?
We raised about 500 crores in QAB last March. That's in 23 March. So this is essentially towards product development. Our existing cash on hand in the bank with investments, etc., is about 750 crores today. So we are fairly comfortable in cash. We are not necessary to go in for cash now. We have used this cash to develop our own products for radars, EW, radios, etc., where there's a huge potential, upside potential available in the market today. So the idea is to build the products, take it to market, go through field trials, and see that we get the business. This is the idea with which we're doing the product development. And the capex itself, we've already built one more factory which is operational. We have additional land about nearly 5 acres with us. So we are going to build some more facility infrastructure so that when the orders start coming in, we are in a position to execute the contracts. So capex is maybe about 150 crores we'll spend over the next 2 years on top of development money, which will spend probably another 150 crores on product development we'll be doing. On the other part, on satellite, we're not very sure how the market size is going to go and the opportunity is going to come. So we are a bit cautious about that, building satellite and putting money inside. So we have full capability to build satellites. We are now holding back a bit. We'll have to see where the opportunities come. Then we'll start designing our own satellites.
Okay, all the best. Thank you for being with us on the channel and speaking about the business. A revenue growth of 20 to 25% is what Data Patterns is expecting in FY25.